Note the trend after the Morningstar signal that told us that the Dow was going to reverse. It hugged the T-line fairly close. When it moved up through the 50-day moving average, we finally saw a Doji in the overbought condition. The probabilities told us that if we saw it open lower, they're going to do some profit taking, probably back to the 50 or the T-line. This is not an unusual price pattern. This is pretty well expected that once a major resistance area is breached, they'll come back to test it to see if it's going to act as support. The advantage candlesticks investors have is we can see what type of candlestick formations occur at these support levels. If there's a candle that breaches it, it tells us we're in a downtrend. If the candles are indecisive and we can see a J-hook pattern starting to set back up, we'll know that we want to be back to buying on any positive strength after that. Basically, the candlestick signals give us a roadmap of what to do without having to kind of speculate whether a trend is moving up or a trend is moving down. The price patterns also give you a benefit of knowing what should be expected. Notice how we have kind of a fry pan bottom, just flat trading down here. Then a cup and handle, but the cup and handle is formed with a Morningstar type signal that stays above the T-line. Told us that if it opened positive, we more than likely we're going to be in an uptrend. Now, in a market like today where it's soggy, a price pattern still ignores what the general market is doing. It also puts us in positions. Do we always get a 10% move off a price move? Not necessarily. We would have been benefited just by having an up day in a soggy market. However, the nice thing about candlestick analysis is that it allows candlestick investors to have a high probability of being in the right position at the right time. That'll be it. We'll see you in the chat rooms.